Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, we'll be looking at the key lessons from the legendary investor Warren Buffett in his letters to shareholders over the last 40 years. Warren needs no introduction. He's the chairman and CEO of Berkshire Hathaway, one of the largest conglomerates with businesses covering insurance, railroads, food and beverages, and even tech. This video is part 6 of the multi-part video series we're doing on the wisdom from Warren Buffett's letters to the shareholders of Berkshire Hathaway. For previous videos, check out the description below. Today we'll be covering 2 key lessons on borrowing money. Before we start, please smash that like button so others can find this video as well, and make sure to subscribe to receive next videos in this series on key lessons from Berkshire shareholders' letters. Now, let's dive into the 2 key lessons on borrowing money from Mr. Buffett. Number 1, never use borrowed money to buy stocks. If there is one thing that infuriates Mr. Buffett, it is borrowing money to buy stocks or to excessively finance acquisitions. It does not mean that Mr. Buffett hates debt, as most of the early success of Berkshire was based on intelligent use of debt, but he's referring to the type of high-interest variable rate debt that consumer investors must take on if they want to use it to buy stocks. When ordinary people borrow money to buy stocks, they're putting their livelihoods in the hands of a market whose swings can be random and violent, even when it comes to stocks of well-managed, reliable companies such as Berkshire. In doing so, they risk potentially losing much more than their initial investment. Mr. Buffett notes that for the last 53 years, Berkshire has built value by reinvesting its earnings and letting compound interest work its magic. Year by year, we have moved forward, yet Berkshire shares have suffered 4 truly major dips of around 50% drop. This table offers the strongest argument I can muster against ever using borrowed money to own stocks. There is simply no telling how far stocks can fall in a short period. Even if your borrowings are small and your positions aren't immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary. And an unsettled mind will not make good decisions. When a stock falls by more than 30 to 40%, a highly leveraged investor stands a fair chance of incurring a margin call, where the broker calls and asks them to deposit more money into their account or risk having the rest of their portfolio liquidated to cover the losses. We believe it is insane to risk what you have and need in order to obtain what you don't need, Buffett writes. That's why Buffett is a fan of some kinds of debt, just not the kind that can leave consumers broke when the market swings down. Number 2, raising debt is like playing Russian roulette. All across the business world, from big corporate boardrooms to venture capitalists to small and medium companies, managers employ the use of debt to improve returns. In recent years, top tech companies have made use of debt. For instance, Apple has around $100 billion in debt. Even Meta, the debt-free company since its founding, is planning to raise debt starting with $10 billion. So, not all debt is necessarily bad. In his 2018 letter, Mr. Buffett notes that we use debt sparingly. Many managers, it should be noted, will disagree with this policy, arguing that significant debt juices the returns for equity owners. And these more venturesome CEOs will be right most of the time. Debt offers companies a way to acquire capital without giving up room on their cap table or diluting existing shares. But debt also forces shareholders into a Russian roulette equation, according to Mr. Buffett. A Russian roulette equation, usually win, occasionally die, may make financial sense for someone who gets a piece of a company's upside but does not share in its downside. But that strategy would be madness for Berkshire. Stock speculators or traders that mainly focus on short term are equally likely to promote the use of debt to increase returns because they build portfolios where they don't worry about the downside risk and believe that they're usually not going to get a bullet when they pull the trigger. But for long-term investors and stockholders, the outcome of usually win, occasionally die doesn't make sense and should be avoided. For now, that's it from us. Hope you enjoyed and learned from these lessons. For other videos in this series, check out the description below. Click on the playlist above or head to the channel page. Smash that like button and subscribe to make sure you receive the follow-up videos on key lessons from Warren Buffett's Berkshire letters. Be sure to smash that like button. Thanks for watching and subscribe for more.